What's up, guys? Are you a real estate investor looking to maximize your sweat equity while avoiding unnecessary taxes? We have come to the right place because in this video, I am going to dive into exactly what you should do when setting up your next deal as a sweat equity partner to make sure that you don't get crushed in taxes. All right, let's get started. So what am I referring to here? Well, a lot of times in real estate, what we find is that you have one person that's going to come into a deal and they're bringing the money or they're bringing the property to the deal, but they don't want to do the work, right? They're going to have another partner step in and manage the project. Now, in exchange for managing that project and dealing with the contractors, or maybe actually physically going out there and doing the work myself, picking up a hammer, picking up a paintbrush, I am going to be tied into that deal. So my compensation for my services comes from getting the deal done. That's called sweat equity, at building value through your services. Now, the problem is, how do you structure these types of deals to make sure that the IRS isn't going to come knocking on your door and saying, hey, you received this value here, therefore, even though it's not cash, you need to pay taxes today on that. I mean, I can't think of a worse situation to be in, and it's happened to a lot of real estate investors over the years where they start into a deal only to find out they're paying taxes on an asset that they haven't even converted to cash yet. That's pretty tough. That's why they're a sweat equity partner, because if they had the money, they wouldn't be in that position many times. They would have just put the money into the deal. So what do we have to do? We have to structure it properly. And the way that looks is as follows. So we had an investor here. And this investor wants to come into a deal, and we've got this property right here where this investor is going to be providing sweat equity to this particular property. Maybe we have this person over here who either is contributing the cash to buy the property, or maybe they just had this house and they're putting the house up and allowing the sweat equity partner to take care of it. So what we need to do is we need to create a limited liability company. We're going to set up an LLC right here. So when we're setting up that LLC to hold this asset, one way to look at this is a joint venture. When we're setting this LLC up to hold the asset, we have to determine then what does that split look like? Because typically this type of split is going to be when the property's sold. We're doing it on flips, and a lot of times what I've seen is it's a 50-50 deal. Maybe yours is different. That's not so important here. Okay, let's assume for purposes of this video that it's a 50-50 deal, meaning that when the property's sold, they're going to split their profits 50-50. So we set up the LLC and we state that this partner has a 50% interest, this partner has a 50% interest. But what's key here is that we have something that's called a capital account, okay, in this particular LLC. And what a capital account is or does is it tracks how much money you put in, or what is the value of the assets that you've contributed to this limited liability company. Now, if this house right here is $100,000 to purchase and it's $50,000 to rehab it, and this individual here contributes that $150K, then their capital account, and this is tracked for tax and accounting purposes, and that's why you have to have good books and records when you're setting up this type of structure. This person will receive a $150,000 capital account. It'll list, right, in the LLC, capital contribution, $150,000. The bookkeeper will track it that this partner contributed $150K. Now, maybe it doesn't come all in at once. For example, on one of our deals in Winston-Salem, North Carolina, a large apartment complex that my partner and I bought with a third partner. He and I, my partner and I, Toby and I, have been funding this deal, doing all the rehab projects that every time we have a turn, we continue to loan money on periodic basis to the company. Every time we're putting money in, contributing money, we're getting a corresponding increase to our capital account. So when we contribute an extra $100,000, the bookkeeper lists down, hey, Clint and Toby just contributed another $100K. Now, why is that important? You're about to find out. So this individual sweat equity partner put in zero. So his capital account will state that he has zero money in the deal. What is his into the deal? It's his efforts, what he's doing, right? Going out there with the hammer, dealing with the contractors. And so how this will eventually play out is when this project is completed and the property is sold, right? Let's say that you got 150 into it and you sell it for $225,000. Okay? The first distribution that comes out of this is going to be based upon your capital accounts. Now that means that since this gentleman contributed 150K, out of that 225 that we receive at escrow, 150 of that will be paid to him. All right, so 150 is going to go to him. So if we take out 150, now why are we paying him 150? Because that's what he put into the deal. He's getting his money back out of the deal. And that leaves us then with profits of $75,000. So then when we do with the profits is we look at, all right, what is the ownership percentage? It's 50-50. So now we're going to distribute 37,500 to this guy and 37,500 to this guy. So that's why when you're into it for sweat equity, your payment comes out of the profits on the deal. You don't get 50% of the value of this property. It's not like this guy's contributing, giving you 75K, right? That's not what he's doing. If he did that, then that is income to you, right? For your services. And that's where you get taxed, and that's where you run into problems. That's why I want to show you a different scenario now that is different than this, meaning this is at the outset. What happens if you're coming into a deal that's already in existence and you're being brought in as a sweat equity partner? How does that look? Well, that actually has happened before. I've dealt with this on a few occasions where someone wants to come into a deal. Let's say we have two partners here that have set up this project. They have a house inside of there, and they just need to bring in a third person to really get it going and kick it off the ground because they're struggling to move this project forward. So this company was originally set up with this partner having a 60% interest, this partner having a 40% interest. How does this new partner fit into the deal? Do you just give them, this partner will give you 20% and this partner will give you 20% if you're going to get a 40% interest for your endeavors? If you did that, if this guy said, all right, here, you take 20%, maybe this one gave him 10. So if we did that, then if this guy gave him 10, he goes to 30. This guy gave him 20, he goes to 40. Now this guy has 30% in the deal, okay? Now why did he receive that interest? He received that interest from these two individuals right here for his services. Okay, so since he received it for his services, then that 30% interest, let's say this property is valued at $200K right now, then he immediately has taxable income of $60,000 because it's a payment for services. That's what you're doing as a sweat equity partner. You're working to get your meal, right? So in this particular case, that is not what you want to do if you're coming into a deal as a sweat equity partner. Instead, what you want to do is you want to have this operating agreement redrafted. You want to restate it, and you want to provide for a separate type of interest, not just the original membership interest. You want them to create what is referred to as a profits interest, okay? A profits interest. So what is a profits interest? It's what I just showed you before, but we carve it out specifically because the deal's already existing to say, hey, I'm bringing in this new partner. The partner's not coming in as an equity partner, they're coming in as a profit partner. So the equity of the deal, the 200K, stays with these guys at their initial 60-40. So if we were to liquidate it tomorrow, this person here gets back 60%, this person gets back 40% of the deal because that's the money they've contributed, that's their value that's already existing there. But going forwards, any future contribution or value or gain in this project is going to be split to this guy 30%. So you give them a 30% profits interest. So that would come into this partner over here. So one guy here is going to have a 30% profit interest. Let me just color these people up here so we can see what they look like. This person here has his 40% or 60% equity interest. And then this one down here, make him green, he has his 40% equity interest. So you look at that and you say, wait, there's more than 100% here. Yes, there is, but they operate differently inside of that partnership arrangement, meaning this, that if we take this project and by bringing in this sweat equity partner here, we drive the value up and it's sold for $400,000. Then what will occur is that when we go to distribute the profits, right? We first pay back the partners their $200K. They're going to be distributed back to these partners, $200,000. So that leaves us with $200,000 left over. Of that $200,000, 30% goes to this guy right here. And then the remaining portion, so 30% of 200K is $60K. The remaining $140,000 that's left is going to be split 60-40 between these two. So the reason we had to structure it this way, and that requires you to change this operating agreement. That is essential. That is what allows us to work out the way I've just described to you. The reason why we did this is that we wanted to make sure that that sweat equity partner who's walking into a new deal isn't walking into a tax bomb that blows up his personal life because now he has to pay taxes on money he hasn't even received yet. So when you're putting together your sweat equity deals, at the outset, it's the cleanest. If you are coming into a deal a little bit later, it's a little messy, but we can always fix it. Just by saying we got to get everyone on board. We redraft the operating agreement and provide for a profit interest that can then be provided to the sweat equity partner. It's non-taxable upon receipt, but then they participate in the gains when the asset is eventually sold. Or if it's a rental property, they're going to participate on that rental income that's coming in. So those are two ways to do it. And there's some other opportunities out there as well, or strategies we have. I like those two. They're always the best way to go, in my personal opinion, when you're creating these types of deals. But if you're thinking about putting together a deal for yourself, hey, reach out to us. We can help you draft and set these types of things up. If you go to the show notes, you'll find that I have a link for a free strategy session. Click on that link. Get yourself set up with a strategy session here with someone at Anderson, and let us show you how to get your assets structured properly so that you're protecting yourself and reducing your taxes. Take care.